Well, joining us now to talk about all things in the markets, we've got equity strategists with us from Credit Suisse, Doug Cliggott, also Dom and John with me as well. And Doug, let me just get your first initial reaction to this breaking news that just came out a few moments ago about the ECB and other central banks providing dollar funding through the end of this year to the Eurozone banks. You saw the equity futures move higher, but in some ways, does this tell you that things are actually worse on the funding side here for banks than we might have known earlier this week?
Well, Betty, I think really it was last week that concerns about funding really started to escalate, and you saw the European indices, trading very, very poorly last week. I think the move today in sort of the turn towards a little more optimism this week is that policymakers are going to be able to come together not to solve the problem, but to buy some time. Because I think the real critical issue in following events in Europe right now, there's 14, 15, 16 different parliaments involved. This is just going to take a lot of time, and so buying time is a big piece of the puzzle, and I think that's what the deal announced just now probably does, is it gives the political establishment all around Europe some time to really figure out what they want to do.
Okay, what we're seeing is this mixed economic data, and that is why, Doug, you have one of the lowest targets on the S&P, right? 1,100.
That's right, Betty. And I think if we take a couple steps back and look at both sort of the broad mosaic of data in the United States as well as around the world, I think that's really the dominant feature. Leading indicators of growth, things like our jobless claims, our ISM surveys. If you looked at the equivalent data sets all around Europe, in China, in Brazil, really every place in the world, growth is slowing down. Since the S&P 500 is really an index of largely of stocks with a lot of non-U.S. exposure, you have to look outside the world. And to us, that's the real sobering fact. We're just slowing down everywhere right now.
Right. Doug, before we kind of hit those industrial production numbers, we had a huge breaking headline about what seems like a coordinated central bank, not intervention, but more of a policy that they're going to support the markets here. So as we kind of go through this, does this change a strategist like you, a strategist's view of where the markets can go when there's that kind of, say, government stimulus at play around the world now?
Well, in some sense, we have to pay attention to it. I mean, think of exactly a year ago. The S&P 500 was trading around 1050. Suddenly, we were told there was going to be another very large asset purchase program by the Fed, and that really lifted the trading range of the S&P 500 and stocks around the world. As soon as they stopped that program in June, we saw markets really everywhere sell off pretty aggressively. My guess is each time you get this coordinated central bank action, I'm not saying it isn't a positive, but I think the positive impact decays over time because the real issue for equity markets is growth and its earnings. Growth is slowing down. We're tightening fiscal policy everywhere. That, I think, means even slower growth ahead, and that means a weaker earnings profile. And that's what you're doing when you're buying equities, is you're buying earnings.
So, Doug, it's John Erlichman. We've seen a three-day rally. It looks like stocks are going to at least open the day higher. Mm-hmm. Sounds like you're saying that's not going to last. What's your expectation for where the S&P ends the year?
We think the S&P probably ends the year lower than we are now. Our guess is around the 1,100 level, but we've got a pretty broad band around that. I mean, realistically, given the extraordinary swings in indices, I mean, we've seen the S&P 500 moving 30, 40 index points within a day. It's really unprecedented. But our core view is probably moderately lower at year end. Right. And the reason for that is we think at year end, everyone's going to be taking down their 2012 growth targets.
Is part of that also because you're not seeing any earnings power in financials?
Well, financials is still a big part of the index, Betty, that's right. And, when you look at what is traditionally the drivers of growth in the financial sector, lending, U.S. households, we think, are very early in bringing down their debt-to-income ratios, so that's going to work against it. And trading activities lower. It's just, in the financial services business, it's a lot tougher to make money than it was 3, 4, 5 years ago.
That's right. Doug, thank you. Appreciate it. Doug Cliggott,
Thank
U.S.
you, Betty.
equity strategist at Credit Suisse.